Hey guys, Toby Mathis here, and today we're going to talk about becoming your own stock market landlord. In order to do that, I'm going to walk you through a couple steps. I'm going to do the 10,000 foot view, and then I'm going to get into some specific examples. And then I'm going to point you to the best resource where you can learn to do this, which is infinityinvesting.com. So let's do the 10,000 foot view first. All right, let's go back and let's just think common sense. If somebody walked up to you and said, I want you to invest in my company, let's say it's a pizza shop, and they said, "Hey, I need $10,000 and you'll be a 10% interest holder." Would you just go ahead and sign over and say, "Here's $10,000. I'll be an interest holder, and hopefully the company becomes worth something someday. Hopefully that pizza shop, and maybe someday you sell it. Maybe someday it'll be worth so much, and I can sell my 10%. Maybe I'll make some money. Maybe in 10 years it'll be worth double or something, and I'll sell it then, and I'll make $20,000 on my, I'll have a $10,000 investment. I'll sell it for 20, so I'll make a total of $10,000." You wouldn't do that, right? You would invest in it and you would say, "Hey, if it makes money, I would like to be paid 10% of the profit." You would never be in a scenario where you're like hoping and praying against the odds that a company is going to be successful over a long period of time, because I mean, it's really hard to do unless that company has a long track record. But if it's a startup, there's about 50-50 chance it's not going to make it. Some people say it's as high as 90%. I say it's probably really on good endeavors, it's about a 50-50 likelihood that'll be around. Now, increasing in value might be less, but that'll still be in business. You would say, I want to receive pieces of the profit. Well, we've lost our minds. And now in the stock market, we do this thing where we invest in things for appreciation. We call them growth stocks, and they don't pay anything to the shareholders. And that's become commonplace. And I would say it's irrational. What you're doing is giving people an interest-free loan. You're giving the company money and you're not asking anything in return, except that maybe the company will be worth more over a longer period of time. And before you say, well, companies always go up, you had a decade where like Microsoft, Intel, all these companies were neutral. Literally, you had a starting point, it dropped, took them 10, 15 years to make it back. If you're a shareholder during that time, you're probably a little bit ticked, because you still have inflation, you still have all these things that are going on. And so even though it says it broke even, it didn't. In other words, your investments lost value. So I put 10,000 in 10 years, I get 10,000 back. I'm not even. I've lost all the time use of that money, and I've had inflation devalue that money. So that 10,000 is not worth 10,000 anymore. It's probably closer to buying power of 7 or 8,000, maybe even less. Inflation's been a little nutty lately if you haven't been paying much attention, regardless of what the government says, right? We know that energy prices have gone up, food prices have gone up, building materials have tripled in some cases. All these things have gone crazy, right? Your buying power is diminished. You need to be receiving profits as you go. And that's what I say when I look at a stock market. And when I say a stock market landlord, I would make this akin to buying a house, a rental property, and not renting it. If you bought a rental property in a community and said, I'm just going to sit it here and I hope that it goes up in value. So I'm going to buy a piece of property. I'm going to buy a house in my town, and I'm going to leave it vacant for the next 10 years. And I'm just hoping that it's worth more. I mean, that's what you do with your own home, right? You're living in it. At least you're getting some benefit out of it, but you're not making any money on it. It's not truly an asset. So in the stock market, we want to make sure that we're renting it. Like you'd never buy a house in your neighborhood and not rent it and not use it, right? You'd just leave it vacant. You would never do that. It just doesn't make any sense. You want to have the cash flow coming in during that time. And it's no different in the stock market. I want to buy a company that's going to pay me. Now, how much is it going to pay you? That's where you look into yields. And if it's sporadic or if the company's not profitable, that should give you pause. And so when you're being a stock market landlord, you're looking at companies with long track records. You're looking at companies that increase their rent every year. When I say increase their rent, I mean they're increasing their payout, their dividend payout, their profit payout year after year. And you're going to say, well, where do you find companies like that? Well, they actually have names for it. You have the dividend kings, 50 years of increasing their dividends at a minimum, 50 years. And these are big companies. I think it's over $1 billion. Like these are big, the Coca-Cola, Procter and Gamble, 3Ms of the world, right? You like real estate, Federal Realty Trust. Every year, year after year, no matter what, they increase the rent that's being paid to the owners. That's number one, is we look at those. There's dividend kings, 50 years. Dividend aristocrats, 25 years. We track inside the Infinity Investing portal companies that have 10 years plus, and we just grab them all. We have a 7-tier rating system, and as to whether it's appropriate time to acquire them. And that's what people do. They go in there and acquire these. Now, that's step number one, is to get the rents. Step number two is to compound that. And the way that you compound that is you sell options against the same company. And if you're not familiar with options, then I would direct you to our Infinity Investing workshop. There's recordings of it, or if you go into the portal, you can watch it. Eric Dodds does a great job of breaking this stuff down. But what it really boils down to is this: if I own something, a share for $100, I can sell somebody the right to buy it from me over a set period of time for 110. In other words, they have a right to pay me more than I bought it for, and it expires at a certain date. So let's make this real. Let's say I have AT&T, and AT&T is an aristocrat. The stock price kind of stays in the same, right around $30. Doesn't move tremendously up or down, but it has a high dividend payout. It pays about 6-7% a year. So just for owning it, it's going to pay you. So if you buy it for 30, you're probably going to get somewhere in the neighborhood of $2 a year for owning that share, right? It doesn't take that long a period of time before you start offsetting the cost of it, actually buying it. Now, I could sell, if I bought it for 30, I could sell somebody the right to buy it from me at 32.50, or let's say $32, well, or 35 if you want to be way out of the money. And they will pay you for that right. Let's say they'll pay you 50 cents a share. Now, here's something that you'll learn. You sell options in groups of 100 shares. So one option is 100 shares. So I would have to have 100 shares. So what would that be? 100 times 30 is what, 3,000. So I'd have to have 3,000, and I might get $100 or $200 for the right to sell my $3,000 worth of stock for $3,300 or something along those lines. Let's say that, hey, I can take a profit and I get paid. And if the company doesn't go up in value and go above that point, it's never exercised, and I just get to keep the money. And I could do that every month, month after month, and I'm bringing in that extra money. And that's called compounding. Compounders are things that I'm leveraging off of the existing asset. A lot of times we think of compounding, we think immediately of compound interest. What you're doing is you're charging interest on the interest that you already charged. It's compounding, and it gets big quick. So if you've ever been on the bad side of a credit card bill, you know what I'm talking about. It never seems like you can pay it off because it's growing so fast. Well, you want to turn that around and do it in your favor. And the way you do that is you buy companies, not just hoping that they go up in value, because there's no compounding there. All I'm doing is just going, I hope it goes up in value. Is you want to buy companies that are paying you, and then you want to also include additional revenue by selling those options against it. And between those two things, you're going to see that you're going to have double-digit returns on most of these companies year after year. If you get called out, you're going to have periods of time where you have the option. Like if you let somebody call you out, you're going to get the profit, and then you just wait for it to go back down and you buy it back. Usually, like most of these companies, they're in some sort of they're in a range. They may be trending up, but there's always a range. The more sophisticated investors in our portal know that they can sell the option at the higher end of the range, and you can buy it back at the lower end of the range and keep the money, whatever that difference was. So I might sell an option, make $200. I could buy it back for 100 next week. And then I go and I wait as it goes back up in the trend. I'm selling it again, and then I'm buying it back. And these companies tend to stick in certain ranges because they're not super volatile, because they're not on speculation, they make money and they pay it out. So there's always a market for that dividend. And that's why these companies, year after year, no matter what's going on, you have pandemics, you have bubbles being burst in the tech market in 2000, you have 9/11 occurring, and you have these massive fluctuations. You have a recession or depression, whichever one you want to call it, in 2008. And these companies continued to be profitable, continued to reward their shareholders. That's what we're focusing on. And then we're adding just another element to where we can actually make a little more money on. That's what it means to me to be a stock market landlord. And you can learn everything you want to know about it by jumping on into our portal at infinityinvesting.com.